देखो, to understand the revolutionary shift represented by cryptocurrency and blockchain, we must first deconstruct the concept of trust in record keeping. Start with the basics. In the traditional financial system, represented by the centralized model in Visual A, trust is institutional. Listen closely here. When you transact, a bank acts as the central authority or the single point of control. Simply put, you trust this bank to update its ledger, its khata accurately. However, this creates a major vulnerability. If the bank's server fails or is hacked, the entire system collapses. Samajh aaya? This is what we call the single point of failure. Now, look at the shift. Distributed ledger technology, or DLT, fundamentally dismantles this axiom. Instead of one central ledger, the database is shared across multiple nodes or computers, as shown in Visual B. Imagine a scenario where every participant in a room has a copy of the same notebook. If one person tries to falsify a page, everyone else checks their copy and rejects the change. Simple, right? This is the essence of consensus-based record keeping. Now, focus here. Let us distinguish between DLT and blockchain. While all blockchains are DLT, not all DLTs are blockchains. Blockchain is a specific linear subset of DLT where data is structured in a chain of blocks. Look at the anatomy of a blockchain transaction at the bottom right. When a transaction request is made, it is not sent to a server but broadcasted to a P2P network. These computers or miners perform validation using complex cryptographic puzzles. Once validated, the data is not just stored, it is sealed into a block. Crucially, as seen in the chaining visual, every new block contains a unique digital fingerprint called a hash of the previous block. This creates a cryptographic seal. Socho zara, if a hacker tries to modify data in block 1, the hash changes. Since block 2 holds the original hash of block 1, the link breaks and the network rejects the chain. This property is called immutability. Why is this secure? Because of SHA-256 hashing and consensus mechanisms like proof of work or proof of stake, which make altering the history computationally prohibitive. Thus, we move from trust in people to trust in code.
As virtual digital assets or VDAs gained prominence, the government identified a critical need to bring this unregulated sector under the ambit of fiscal and regulatory oversight. The Finance Act 2022 introduced a specific definition for VDAs, which is a broad categorization covering not just cryptocurrencies but also non-fungible tokens or NFTs and other cryptographic tokens. The primary intent here is to curb speculative trading and track the money trail. This leads us to the taxation structure shown in the fiscal treatment funnel diagram. Pay attention because this hits the pocket. The government imposes a flat 30% tax on income from the transfer of VDAs. It is vital to understand the severity of this provision. Unlike stocks or businesses where you can deduct expenses, here no deductions are allowed except for the cost of acquisition. Furthermore, and this is painful, if you incur a loss in Bitcoin, you cannot set it off against profits from Ethereum or your salary income. The loss is dead, the profit is taxed. Clear hai? Beyond income tax, there is a surveillance mechanism embedded in the form of TDS or tax deducted at source. As illustrated in the SEC 194S TDS compliance cycle, when a buyer pays a seller, 1% of the transaction value must be deducted and deposited with the government treasury. The logic here is not just revenue collection, but establishing an audit trail to monitor the flow of assets. However, remember this: taxation does not imply legality or safety. To prevent the misuse of crypto for illicit activities, the sector was brought under the Prevention of Money Laundering Act or PMLA 2002 in March 2023. As seen in the PMLA firewall matrix, entities like exchanges and wallet providers are now designated as reporting entities. They are legally obligated to perform KYC, know your customer, and maintain records for 5 years. They must report suspicious transactions to the FIUIN or Financial Intelligence Unit. This creates a regulatory shield where anonymity is pierced to prevent money laundering, ensuring that while the asset is virtual, the compliance burden is very real and tangible.
We often confuse digital payments with digital currency, so let us establish a foundational distinction. UPI is merely a payment interface. It is a messaging system that moves existing physical cash sitting in bank vaults from one account to another. बस मैसेज जा रहा है. In contrast, central bank digital currency known as CBDC or e-rupee is money itself. It is a sovereign liability, meaning it is a direct claim on the Reserve Bank of India, just like the physical banknote in your pocket, but in electronic form. This is distinct from private cryptocurrencies, which have no central issuer and no sovereign guarantee. The RBI has structured this implementation through a two-tier model, as visualized in the pyramid diagram. The RBI sits at the apex, responsible for minting and issuance. However, note this carefully. The RBI does not deal directly with the public. Instead, it distributes these tokens to financial intermediaries like banks, who then manage the distribution and KYC for end users. The functionality of CBDC is split into two specific classifications: wholesale or EW and retail or ER. Look at the functional diagram on the right. Wholesale CBDC acts as a closed-loop circuit restricted to financial institutions. Its primary purpose is the settlement of interbank transfers and making the GSEC or government securities market more efficient by removing settlement risk. On the other hand, retail CBDC is token-based and accessible to the public, functioning exactly like physical cash. The transaction flow shows that user A sends tokens from their wallet to user B or a merchant via a QR code. This supports both P2P, person to person, and P2M, person to merchant. A critical aspect here is anonymity. In physical cash, small transactions are anonymous. Similarly, the CBDC architecture allows for managed anonymity for small values. But for high-value transactions, the trail is traceable to prevent illicit use. This hybrid approach attempts to merge the privacy of cash with the efficiency of digital tokens. Makes sense, right?
The crypto ecosystem faces a major hurdle: extreme volatility. Socho, curious, a currency that fluctuates 20% in a day, cannot be a reliable medium of exchange. To solve this, we have stablecoins, which are crypto assets pegged to a stable value, like fiat currency or gold. As shown in the stablecoin mechanisms tree, there are three main types. First, off-chain collateralized or fiat-backed, where for every digital coin issued, one real dollar is kept in a bank reserve, for example, USDT. Second is crypto-collateralized or on-chain, where volatile crypto assets are used as collateral, usually over-collateralized to account for price drops. The third and riskiest category is algorithmic. Here, there is no collateral. Instead, a smart contract modulates supply and demand to maintain the price. Look at the depegging risk warning icon. It highlights the danger here. If the algorithm fails during a panic, a death spiral occurs, as seen in the Terra Luna crash. This infrastructure enables DeFi, or decentralized finance. Refer to the DeFi versus traditional finance flowchart. In traditional finance, a bank sits between the user and the market, acting as a safety net and intermediary. In DeFi, the bank is removed and replaced by a smart contract. Users interact directly with code to lend, borrow, or trade. While this increases efficiency, it introduces unique dangers, visualized in the risk ecosystem map. Since there is no human intermediary, if the code has a flaw, it creates smart contract vulnerability which hackers can exploit. A unique threat is the flash loan attack, where a bad actor borrows millions, manipulates market prices on a DEX or decentralized exchange, profits, and repays the loan all in a single blockchain transaction. Furthermore, the risk of rug pulls exists, where developers abandon a project and run away with investors' funds. Without a regulatory safety net, DeFi remains a high-risk, high-reward frontier. Be very careful here. As cryptocurrencies operate on a borderless global scale, national regulations alone are insufficient to stop financial crimes. This brings us to the role of the FATF, the Financial Action Task Force, the global money laundering and terrorist financing watchdog. FATF Recommendation 15 specifically mandates standards for virtual asset service providers, known as VASPs. The core philosophy here is a risk-based approach, where nations must identify vulnerabilities in their crypto ecosystems. The map visual indicates how funds can flow across jurisdictions, bypassing traditional banking choke points. The major red flags identified include anonymity-enhanced cryptocurrencies, or AECs, and mixers, or tumblers, which obfuscate the origin of funds, making them ideal vehicles for illicit finance and sanction evasion. To counter this, the most critical enforcement mechanism is the travel rule. Listen, this is important. The objective is straightforward: prevent criminals from using crypto to move funds without a trace. In the traditional banking SWIFT system, when you send money, your identity travels with the money. The travel rule applies this to crypto. Look at the travel rule mechanism diagram. When a sender initiates a crypto transfer above a certain threshold, typically USD or Euro 1000 from Exchange A, the originator VASP, Exchange A cannot just send the crypto to Exchange B, the beneficiary VASP. It must also transmit PII, personally identifiable information regarding the originator and the beneficiary. This data includes the name, account number, and physical address or ID. Exchange B then matches and screens this data before releasing funds to the user. This ensures that even in a decentralized technology, the participants are identified, effectively creating a firewall against sanction evasion and funding proliferation. Cleared here?
The regulatory landscape for crypto assets is shifting from isolated national responses to a coordinated global framework. A pioneering step in this direction is the European Union's MiCA, Markets in Crypto Assets Regulation, which is the first comprehensive cross-jurisdictional regime. If you look at the MiCA regulation temple visual, you can see it rests on 4 key pillars. The most significant is consumer protection, making service providers liable for hacks or losses, which was previously unheard of in the wild west of crypto. Imagine that shift. Another pillar is sovereignty, enforced through stablecoin caps. MiCA restricts non-euro stablecoins to protect the monetary sovereignty of the Eurozone. It also mandates environmental disclosures regarding the energy consumption of proof-of-work mechanisms. However, देखो, the internet does not respect borders. A ban in one country simply pushes the activity to another jurisdiction. This realization shaped India's G20 presidency stance in 2023. As illustrated in the roadmap diagram, India facilitated a global shift from an isolated ban approach to global coordination. The outcome was the adoption of the IMF FSB synthesis paper. The key tenets of this consensus are crucial. First, there is no granting of legal tender status to crypto. Sovereign currency remains supreme. Second, instead of a blanket ban, which is hard to enforce, nations agreed on strong licensing and registration standards.
Third, there is an emphasis on data sharing among nations to track tax evasion. This is particularly vital for emerging markets and developing economies, or EMDEs, which are more vulnerable to the macro-financial risks posed by volatile crypto assets. Thus, the G20 Delhi Declaration marked the beginning of a unified global regulatory rulebook. It is a big deal, bilkul.
Moving beyond currency, the technology offers a transformative potential through tokenization of assets. This process involves converting rights to an asset, whether it is real estate, art, or securities, into a digital token on a blockchain. Refer to the transformation process diagram. Typically, a high-value asset, like a painting worth $1 million, is illiquid. Very few people can buy it. However, the tokenization engine can slice this asset into 1,000 digital tokens worth $1,000 each. This is fractional ownership. It creates deep liquidity and allows for 24/7 markets. Underlying this is the smart contract layer. As shown in the logic box, these are self-executing contracts with if-then-else logic directly written into code. For example, if payment is received, then transfer ownership. Simple logic, right? This eliminates the need for expensive lawyers and enforcement costs, streamlining settlement to T+0, meaning instant settlement. This shift facilitates the evolution of the Internet towards the Web 3.0 economy. Let us trace the three-stage evolution matrix. Web 1.0 was the information economy, a read-only static web, where users were just consumers of content. Web 2.0, the platform economy, brought interactivity or read-write, but it led to centralization. Tech giants like Google and Facebook harvested user data, turning users into products. Now listen closely. Web 3.0 represents the token economy, or read-write-own. Its core traits are decentralization and user sovereignty. In this model, users own their data and assets through wallets, not central servers. This interoperability allows you to take your digital assets from one platform to another. This impacts governance through DAOs, or decentralized autonomous organizations, where decisions are made by token holders rather than a corporate board, fundamentally shifting power from tech monopolies back to the creators and users. It is a massive power shift.
Finally, as we digitize value, we inevitably invite sophisticated cybersecurity threats. In the financial domain, these threats are not just about stealing data, but stealing liquid assets. The threat vector pie chart highlights that while phishing, which is social engineering, and malware remain common, blockchain introduces unique vectors. Cryptojacking is a silent attack where hackers infect your computer to use its processing power for mining crypto, slowing down your system. Chupke se kaam hota hai. A more structural threat is the 51% attack, visualized in the anatomy diagram. If a hostile entity gains control of more than 50% of the network's hash rate or computing power, they can rewrite the blockchain's history, enabling them to double spend coins and destroy the ledger's integrity. Additionally, key theft remains a critical vulnerability. Unlike a bank password which can be reset, the loss of a private key results in the irreversible loss of assets. Once gone, it is gone forever. Serious. To combat these risks, the Indian government, through CERTAN, the Indian Computer Emergency Response Team, issued stringent guidelines in 2022. The compliance timeline infographic highlights a critical mandate, the red zone. Reporting entities, including crypto exchanges and wallet providers, must report any cyber incident within 6 hours of detection. This is a very tight window, designed to enable rapid containment. Furthermore, refer to the storage depot visual. There is a mandate for log retention.
all ICT logs must be maintained for a rolling period of 180 days to 8 forensics. For user identity, KYC data must be preserved for 5 years, even after a user closes their account. Finally, to ensuring all logs match up during an investigation, the synchronization visual shows the requirement for NTP or Network Time Protocol synchronization. All system clocks must be synced with the servers of the National Physical Laboratory (NPL) or NIC. Non-compliance with these directives attracts penalties under the IT Act 2000, signaling that cyber hygiene is no longer optional but a legal prerequisite for operating in the digital finance space. बिल्कुल क्लियर है?